Welcome back, guys, to another Zero DTE podcast. And today we're on season 2, episode 25, where Ernie talks about different types of strategies and how to maximize gains. So make sure you stay tuned. If you're interested in becoming a pro trader, as always, check the link in the description for Ernie's course. And I hope you enjoy. Cheers, guys.
How you doing, friends? Ernie here, and this is the final hour show, 0 days to expiration. And today we're going to go over how to take profits on the Batman, the classic fly, basically the out-of-the-money butterfly, and what is our framework for doing that, for taking those profits? How do we go about it? How do we decide when to take a small profit or hang on for something that's something bigger? And that was a particular question in my service today. Someone had asked, if you take all these small profits, how do the big profits? Wouldn't that kind of skew the long-term positive expected results with this asymmetry? And yeah, I mean, if you thought that you were always taking just the small profits, of course, if you never allowed yourself to take the larger profit, of course, that's exactly what would happen. That would be like saying, I don't know, what would be the analogy for that? Maybe going to the bowling alley and saying that, yeah, I can bowl a 300, but I am going for one pin at a time. So you roll it down and you just try to hit that outside 10 pin. Or what's the opposite, the 7 pin? Is it the 7-10 split? Yeah. So you're always going for that outside pin, and that's all you ever go for. And yeah, of course, you would never have a chance of ever getting a strike, right? But that would be patently absurd. The only time that you're going to go for that outside pin is if that's the pin that you need to go after, to fill a spare or something. It's really the same thing in trading. If you set up a strategy and you don't allow price to ever move inside the profitable zone that you want to take profit in, of course, you're going to skew your results. But why would you do that? That doesn't make any sense. So I was left scratching my head a bit on that whole premise. And so what I decided to do was to do a whiteboard session here on Zero DTE on the final hour show and show you how we actually go about taking profits. And what is the mechanism? What is the framework that we use? All right. This is going to be a pretty in-depth session. This is stuff that really is the meat of what we do. Now, just because I'm going to show you this framework and this technique doesn't mean that all of a sudden, hey, I know the framework and technique, I can go off and I can do it. It takes a lot of practice. It takes trial, error to understand the nuances of the decisions that you have to make, understanding how premium grows within a particular strategy that you put on. Where's the volatility? What's the change in that volatility? All of those things are very important. And those are things that decision-making process that you have doesn't come all of a sudden to you. There's a lot of value that you have to put into the repetition of doing something over and over so that you can develop the confidence in taking that profit. Now, why would I take a smaller profit today as opposed to a larger profit? And I'll go into that in a second here. All right, so the very first thing that I want to do is talk about a trade that I put on earlier. Actually, the way we'll start is let's first talk about what the strategy is, and then I'll show you the framework that we use. And I'm going to do all this on a whiteboard session. So I've got my iPad here, and let me see if I can set this sucker up, get it going. I have to get it to mirror. All right. Is that mirroring? No, that's not mirroring yet. Hold on. Get the display arrangement. I don't know why it doesn't mirror all by itself as a default, but it doesn't anymore. Ever since I updated it to the new iOS, it doesn't default to mirroring. And I use this. Okay, so we're all set there. So I'm going to switch over to the iPad. That's camera 3. There we go. There's the iPad. And I'm going to use the program called Procreate. It's an artistic drawing program. It's basically a painting program. And as you can see here, we've gone through lots and lots of whiteboard sessions here. It just goes on and on and on and on and on. All right, let me go back to the top here. And we'll create a new session and select my color. Let's see. We want to draw in. Okay, so let's start with what we do. So we're trading out of the money butterflies. And out of the money butterfly, let me move this. I got to make some room here. I've got a huge desk, but I've got so much. I've got an iPad, a MacBook on it. I've got a soundboard, a video switcher, three monitors. Believe it or not, with a desk that's over 6 feet long, I have no room on it. All right. And is that showing up? It's not showing up. It's showing up as dark. Why is that? I don't want to show that. I want to show that. All right. Wow, all of a sudden everything went dark. What did I do wrong? All right, let's try. Oh, I think I hit this. I hit the fade to black button. See, that's because I have no room on here. Yeah, I hit the fade to black button. Go back to the iPad. There we go. All right. What we do with our strategy, there are three pillars to our strategy. One is asymmetry. So asymmetry means we have an asymmetric relationship between risk and reward. Now, most of you, when you're trading with credit spreads or verticals or even butterflies, you're probably at best doing like a 3 parts risk to 1 part reward, or sometimes even with the at the money but iron condor type of thing on 0 DTE, it would be 5 to 1 or even 10 to 1. All right. We don't do that. We have that's asymmetric, but it's in the wrong direction. What we do is we do 1 part risk to 10 parts reward, or approximately 10. Usually it's somewhere between 9 and 20. All right. So that's a very different story. So that means that we're taking very little risk. So that's the first part of our strategy, is asymmetry. So I'll put that up here. That's the first tenet of our strategy. Asymmetric risk to reward. The second part of our strategy is premium collection on 0 DTE. Now this is pretty evident because that's what we do. So we'll just say it's premium collection. But we do it on a day when the ratio between the amount of premium that you collect and the time that you have to collect it is at its maximum. And that's on the 0 DTE event. And then the third part of our strategy is our process. And within that process is something that I'm going to go over today, and that's the framework. Our profit-taking framework. All right, so there's our 3 parts. Instead of erasing it, I should have just kept that there, huh? Just gone to a new screen, but that's okay. All right. So how do we achieve asymmetry? We achieve it by that 1 to 10 or 1 to 9. There's a very easy way that we do it. We do it with the 10% rule. And we do it with an out-of-the-money butterfly. Now, I'm sure a lot of you have heard about the Batman butterfly, which is basically 2 butterflies. But let's start with the most basic thing, and that's the out-of-the-money butterfly. And the way we achieve, let's say that this is where at the money is. This is where the current market price is. So today, right now, the current market price is at about 4,100. So let's say that's where it is, 4,100. Is that on the S&P, or that is on the E-mini futures? No, that's the S&P. So we're right around 4,100. Man, the market just took a big hit today. Took a big hit because the Federal Reserve came out with their minutes at 2 o'clock just an hour ago. And apparently the market didn't like that. I would have to guess that the minutes are saying something to the effect that the pain will continue, or that's how they're interpreting it. Or, in other words, we will continue our rate hike. We will continue the beatings until morale improves. That's essentially the message from the Fed. All right. So the way we get our asymmetry is we put our butterfly out of the money. Now, in the money would mean that we put the butterfly right here. And this is probably what most of you do. And when you get into a butterfly like that, it's very difficult to consistently get profit because price wants to move this way or that way. And in order to make profit, you have this range here, and you really want to stay somewhere within this range to get the maximum amount of profit. But if that range is only about, I don't know, say 20 points, the market typically moves way more than 20 points. Often it can move like today. It moved, let's see, at the high, it was at 41.27, actually about almost 41.30, and now it's at 4100. So that's 130 points. How in the world, even if this were a 40 wide on either side, that's 80 points wide, you still wouldn't have made money. If it was 100 points wide, you still wouldn't have made money. And your risk would have been huge. Your risk on a typical at the money butterfly like that would be something like this. It wouldn't have, this is out of proportion here. It would have looked more like this, where your risk would have been maybe 2 to 1 max. So you would have been, say, betting $200 to make $100. So you're risking, or let's say $1,000 to make $500. And the 500 would only be if you got right here. The chances are that you would get somewhere over here. So in reality, you'd be risking, say, $1,000 to make, I don't know, at realistically maybe $100. And it's the same deal if you would put on an iron butterfly or an iron condor. You would have done something similar. So what most people do in 0 DTE is they put on an iron condor that looks kind of like this, where the width of your spreads are between 5 and 10 points, something like that, but their delta is way out there, maybe a 5 to 10 delta even. So now your risk is something like, let's say it's a 10 wide, $1,000 to make a max of $100, but no one takes 100 because you're worried about premium decay, because your profit curve kind of looks like this. You move back and forth and you start going down that profit curve. You're worried about a max loss of $1,000. So what you're hoping that premium will increase. This will go up in that tiny little spot. And so what most people do is they'll take 50% of that as soon as they hit 50%. But that happens on a small number of cases. Or it can happen regularly, right? But in the meantime, your price is moving back and forth. You're biting your nails because you're way underwater. And most people will put a stop at about $300, which often gets hit. All right? So that's the typical situation. We don't do anything like that. We do something completely the opposite. So I'm going to go back and create another picture here and show you what we do. And don't worry, we're getting to all the good stuff. So let's say at the money is right here again. Instead of putting it at the money, we put the butterfly out of the money. Out of the money butterfly. And when we put it out of the money, this risk gets very small right here. And typically we have 1 part risk to as much as 10 parts reward, like that. Now that doesn't mean that you're going to hit that 10, but what it does mean is that your real-time profit curve, when you put it on, looks like this. It's really wide. It's from here and extends way out like this. So now, when you get into the market, now this would be what would be considered a directional trade. You're only going to make money if the market moves this way. If it moves this way, you're shit out of luck. But if it does move this way, you have a lot of range to make money, and you can make money anywhere around here. And of course, if it gets into the profit tent, and as the day grows on, this curve will start increasing like this. All right? So for a wide range of prices outside of the profit curve, you can make money. And if it gets inside of the profit tent, this area that I'm going to color green, anywhere in here, you're going to potentially make a lot of money. Now, here's the cool part. Because of that asymmetry, even if you're way out here, you can still make as much as 50 to 250% return on your money. You get inside the profit tent and you can start making anywhere from 250 to maybe as much as 1,500% on your money, depending on what your risk to reward is. Let's say 1,000%. Big profit-making potential with very little risk. Now, that all sounds great, but how do you know when to take the profit, etc.? It's not an easy proposition. I mean, it depends on what happens in the course of a day. Like today, for instance. Let's take a look at today. And so what I need to do is bring this strategy on board here. Just give me a second. And switch up the screens. All right. So here we had a Batman on, which is 2 of these trades. But here's one of these trades right here. And it is currently in profit. I'm going to turn off the other one as if we only had one so you can see it by itself. So you can see right here, it's sitting very neatly inside of the profit curve, and it's got substantial profit. The original risk on this trade was $450. There's a maximum return of about $3,550. All right, because this is a 40 wide. Actually, this is a 20 wide, and there are 2 of them. Let's simplify this and bring it down to just one, so we don't have to multiply everything together. All right, so if this were just 1 wide, I took a 2 wide on my Fidelity account. This is modeling what I'm seeing on my Fidelity account. So when I got into this trade, it cost me $225 to get in. It is a 20 wide spread. That means that my maximum profit is the 20 wide spread, which is $2,000. You multiply it by 100, minus the debit, which was $225. So that brings it down to $1,775. So that's my maximum profit if I were to end up right here in the middle at expiration. Right? You can see it down $1,775. It's right over here. All right? So that's my potential. Now, if I get out of the trade right now at 3:22 in the afternoon, I've got a clean $400 that I can make. I can get out of this trade, and I've made money. Now, of course, do I want to get out now? That's part of our framework. Now, what would happen if I'm sitting out here? I'm still in profit. Would I want to get out now if I'm out here? All right. What if I'm over here? Then I'm out of profit. Obviously, there's nothing to do here. I'm hoping that price will drop and get back into there. But if I'm out here, there's not much for me to do. What do we do? So there are all these decisions to make depending on where you are in relation to this profit curve and that profit tent. Remember, this profit curve right here, the purple line, is the real-time P&L. The cyan line that most of you know of when you look at a butterfly is also a profit curve, but that's at expiration. So this is what profit will look like depending on where I am at expiration on that cyan line. And the purple line is where it is right now, right this second. Now, over time, that purple line is going to fill up and take the shape of that cyan line at expiration. It's constantly growing throughout the day. At the beginning part of the day, it was flat. All right, so now we have this situation. See, it just moved up a little bit. Now if I took profit, I can take about $500 of profit. If it keeps on going down and ends up anywhere near the center, I'm going to have a good day. Anywhere from $1,000 to as much as $1,700 of profit. That's what you call a good day for just a $200 risk. But we need to be able to, now see it's moved further. Now it's at 576. We can do this all day. It's getting exciting. And now the choice is, do I get out or do I take the profit now? Do I wait until the expiration? If I wait, there's a chance that price could go out of here. It could evacuate and make nothing. Or it could go right to the center and I can make a crap load of money. Oh my God, decisions. It's a high quality problem though, because you're taking a small risk to make a very large amount of money. And that's where the whole process comes in. Remember I said that there are 3 parts to this. There was the asymmetry, premium collection, and then the process. And within the process is the framework. The process is really big picture. The framework is one of the tools that we use within the process where we're deciding how to best take advantage of this situation. So this is what we're going to talk about. What is that framework? All right, let's see. We've got a few people watching now. Thank you very much. We'll do a roll call in a little bit, but thank you very much for joining. I don't understand some of these comments, but they're kind of weird. I suspect that they're not all traders. But if you are a trader, say hello, okay? Say hello and then give this video a thumbs up. Because right now we're going to get into how you actually make profit here. Man, while we're just sitting here, now it's worth $650. Holy crap! We're printing money as we're doing this show. All right, so now we're going to go back to the whiteboard, and I'm going to duplicate what you see here. When I first got into this trade, price was way out here, right? And so it was just like the thing that I was showing you on the whiteboard. So let's go back to the whiteboard. And I'll put it in the exact same orientation as that trade so that there's no confusion. All right, and the center strike on that was at 40.80. And it was a 20 wide, so it went to 4,100. And out here, and then went down as far as 40.60. All right. And then the at expiration curve looks like this. And when I first got into the trade, the real-time profit curve at the money was out here. So the real-time profit curve looked like this. And this was one of the break-evens. And then the other one was way, way out this way. But now, if we were to go back and look at it, we can see that it's later on in the day. Oh, by the way, this trade right now is worth $700. So now that profit curve is growing, right? So now it looks like this. Now, one of the things that you'll notice about it, besides the fact that it's growing this way, and this is going this way, and this is going this way, so that means that the break-evens are moving from here to here, right? And there's also the break-even of the butterfly at expiration. That never changes. But this break-even changes, and that break-even changes. This one doesn't change. So now we have really 3 different zones. We have everything to the right of break-even. We're going to call that zone 1. We have everything in between the real-time expiration break-even and the at expiration break-even. We'll call that zone 2. And then we have everything in between the butterfly, we'll call that zone 3. All right, so that's a very simple way to break things down. And we can go back to our there, and we can see the same thing, right? Zone 1 is way out here. Zone 2 is in between here. It's getting smaller and smaller, and zone 3 is in here. Now we move back a little bit. We came down this curve because price is going up now, and we were up to $700, $750. Now we're down to $538. Well, there's got to be a decision-making point there, right? What exactly is that decision-making point? When you've achieved an unrealized gain of a certain amount, that should be your trigger. And so that trigger is where we start off with our framework. Now we're in there's another part to our framework here. Let's go a little bit further. And we're going to look at this in terms of time too. The first part of this framework, we're looking at it in terms of the proximity of price. But there's another dimension to this, and that's what I haven't really said. I kind of implied it though, and that's the dimension of time, because this profit curve, I'll just take a little blue mark, and this profit curve here is at one time, say T1, and now it's at another time up here, T2, right? That's changing all throughout the day. At T1 versus T2, those are two very different times. So what we do is that curve is changing throughout the day, and that's really representative of the premium that's decaying on that option. So let's do one more chart to give you an illustration of what premium looks like as it's decaying. You've probably all seen this chart, I'm sure. Over the course of a day, let's say that this is 0 DTE right here. And then this is the beginning of the day, 9:30 a.m. And premium starts out way up here. Whoop. Starts way up here. And then as the day progresses, it does this until it decays down to nothing. All right. We could also flip that the other way and say it's like it does this. It decays up. In terms of our butterfly, if we were looking at our butterfly, it's actually increasing in value. But what's happening is that it's premium that's decaying on both sides of that butterfly. And when you subtract it out because it's a debit trade, it's actually looking like it's increasing to us. All right. So all we can say is that as this is decaying, we're making money if we're anywhere on that profit curve. And so what we do is we break that day down into time periods. All right, so we'll break it down. We'll use the green. So there's a time period here. There's a time period here. Notice I make this time period smaller. And there's a reason why I do that. And that is because of the shape of the curve in each one of these time periods. This time period up here, we call the morning session, goes from the open to noon. This one goes to 2:30, and this is the close. We call this the afternoon session. Really amazing name. And then we call this the closing session. And the reason why we break it down that way is because the profit curve has a very distinct character in each one of these sessions. Here it's flat. Here it's like a dog leg. And here it's falling off a cliff. So that implies then that we're going to have different ways of approaching our profit taking in each one of these time zones. Time zone 1, time zone 2, time zone 3. So now what we've done is we've created a framework on not only in terms of time, it's a two-dimensional framework. One dimension is time, where we look at how the profit curve changes and how we need to also change our strategy on how we're going to handle that. But also back here in terms of price and its proximity to that curve. Because here's that curve. Right? We could be sitting in zone 1 or zone 2 or zone 3 in one of these time frames as well. We could be, for instance, in zone 1 in time 1. If we were in zone 1 in time 1, that's usually where you're going to be because it's the beginning part of the day and it hasn't moved towards your fly yet. But if we're in time 1 in zone 3, we would be here, but the curve would be really flat. If we were in the afternoon session, time zone 2, but zone 3, then the premium curve is going to be a little further up. It's going to be up here somewhere, right? And it's going to look a little different. One thing that you may notice also, the other thing that's changing is the steepness of this profit curve. You can call that your gamma risk because what that is doing is showing you the sensitivity to price moving back and forth like this to the value of your trade. So these are things that you need to keep in mind when you're trading this. And I'm going to bring up another chart so that you can see exactly what we're talking about, this framework. And so what I'm going to do is bring you into our inner sanctum to the Discord room of 0-DTE so you can see what's going on there. And this is our Discord room. And here's the framework that I was just talking about. So it's 2 dimensions. Each one of these big legs represents the different dimension in time that I showed you earlier. Remember that? I showed you that right here. I showed you the 3 different time zones, 1, 2, and 3. That's each one of these big legs here. The morning, early afternoon, and then the late afternoon are the close. Right? Then I also showed you the proximity dimension. Zone 1, Zone 2, and Zone 3. And that's what we're seeing on each one of these legs. So there's a Zone 1 here for morning, Zone 2, Zone 3 for the morning, and a Zone 1, 2, and 3 for the afternoon. And we kind of negate Zone 3 in the late afternoon. We just do a Zone 2 and a Zone 3. Because if it's in Zone 1 in the late afternoon, then you're SOL. You might as well just forget about it. You're probably not going to make profit. All right? Now, the reason why we create this framework is so that when we are in one of these situations, each one of these situations, we have to evaluate the market and decide what we're going to do. Are we going to take profit or not? Now, that answer for time for the morning is going to be very different if we are here or here, if we're in the Zone 1, Zone 2, or Zone 3. It's going to be different in a lot of different aspects. This starts getting really, really complex when you start talking about different widths of flies, because we choose different widths of flies for different reasons. And I'm going to show you that in a second. But that is generally our framework. It's 2-dimensional. We split it up into a time frame and then a proximity to the strategy, price proximity. And then where those 2 pieces intersect, we have a separate strategy for how we're going to treat our trade. Now, the things that can influence how we treat it within each one of those intersections can be affected by volatility, the width of our fly, any economic reports that are coming out, the underlying market structure, price action, all of those things come into play. And that's why trading is the hardest way to make easy money, because you need to become a master of all of these different aspects of the trade and understanding how each one of those aspects is going to affect the trade and what your probabilities of profiting are at each one of those intersections in the framework. So I'm sure that you thought that trading was just this simple thing. Someone gives you a strategy and it's either profitable or not. You couldn't be further from the truth. If you're thinking that way, yeah, that's what a typical retail trader would think. This, what I'm showing you, is how a professional thinks about trading. Within each one of these situations, we have probably gone through dozens of trades and experiences that all have different or have unique characteristics with them. And we've learned a tremendous amount. And each time that we go through one of those experiences, we log and we journal that experience and we learn from it. And then over time, we start building. Yeah, I'm going to go to the big head here. And within each one of those intersections of our framework, we've developed a unique position or a unique approach to how we're going to handle or manage our profit. And it's very nuanced. There's a lot of things that can affect it. Like I said, some of the biggest things that affect it are the underlying market structure or economic reports that are coming out, events that could be happening at that time, the momentum that you see in the market. They're all going to compel you to make a decision. Do I hold or do I take profit? And that could change from moment to moment. Do I hold? Do I take profit? If I hold, what are my chances of gaining more profit? Or what are my chances of losing some? How much am I willing to lose? You have to ask yourself that. How much have I maxed out at so far in this go around? You saw me, I got up to about $750. That was my peak profit so far in this trade. Right? How much of that am I willing to give up before I say, that's it, I'm done, I'm out? Is it 50%, 75%, 10%? What's the number? What's optimal for you? Underneath that trade, is there some price action or market structure that I should be worried about? Or maybe it's something that will support my decision. Is there some support zone there that I can feel good that, man, I can hold on here because there's support or resistance at this particular price that may contain it. And so it's probably best that I wait until I get closer to expiration, because as I get closer to expiration, that profit curve is continuing to rise and making more money for me. You saw it just a little while ago. So all of these are decisions that you need to make. Now, making those decisions, you're not prepared to do that. You're getting into this game totally blind. You have no idea what you're doing. You're just hoping, and of course, hope is not a strategy, that price will be in there and then you're going to get some profit. Someone asked me earlier, why are you taking profit earlier in the day? Because under the certain set of circumstances, I felt that was the best probability of me profiting. Well, I didn't actually take it, but I'm just saying that would be an example. I might, under those circumstances, feel that, okay, taking that is going to be my best probability of profiting, so I'm going to take a small win. Why not wait? Because of the underlying structure and all the other things that I've learned over doing dozens or even hundreds of these trades, I've decided to take it then. There may be other situations where I decide to hold on because I think it's going to go deeper into the profit tent and make more money, or wait because I think that over time that profit's going to grow as that premium curve expands. All of those are knowledgeable aspects of the trade, aspects of the system and the framework that I am familiar with, that I have total confidence in because I've done it over and over, dozens, hundreds, or even thousands of trades. I've logged, I've journaled, I've recorded all of my activity and the times that I've done good things or bad things. I've recognized patterns of behavior that I've managed to correct, or things that do need correcting. And so I have to implement a new habit forming exercise to get me back on track, to help me optimize it even better the next time. This is what a pro does. This is what a pro trader does. This is how a pro trader outperforms a retail trader, you, every time. If you'd like to learn how to be a pro trader, go down below. You can give this service a try. 4-week trial. You'll get to see how a pro does it. And it might not be for you. You might decide that it's too much for you to do, that you think that there's a better way. You're going to go to Joe Blow alert service and get their trades and let them feed you all the information and you'll just make money. Go ahead. See how that works for you. It's funny when you say it. When I say it, I just think, man, I wish I could take their trade. I wish I could be the broker that takes your trade. All right, so we'll get back to where we are. Okay, so while we were talking, so here was where we were before. Yeah, what are we showing here? So this dotted line is where we were before when we left this, but now price has moved down to here. Now, when we left this, we were at about $750. If price had stayed there, this profit curve has grown. Now it would have been worth almost $900. But price moved down to here, down to $588. Still a pretty good deal, right? But I went from $750 to $550, right, in a very short period of time. I would have had to make a decision there. Would I hold on for the potential that price would go further down? Do I have any good feeling that price will go down? Is there something else that might make me think holding on here might be a better thing to do? While we're talking, now it is just increased in value to $700. Right? So, yeah, there are other things that I can take into consideration. Like I can go back and look at the underlying chart, right? Where is it positioned? What does the market structure look like? What is the price action telling me? Well, this price action isn't looking too healthy here, to tell you the truth. If we test this low here, it's possible that we'll take another leg down and then maybe do another return up. Who knows? But if it gets down to here, should I take that profit? And it is almost getting down there. I would say, given that situation, the max profit that I can achieve there, if price ends up right there, is going to be $861. That's the blue line. If we move, what is the chances of it moving down to 4080? What are the chances of it moving down to 4080? We're currently looking at the E-mini S&P, which is not the SPX. So 48, see, currently the price is sitting at 4090, right? The E-mini S&P is about 25 points higher than the SPX, which is what our trade is on. All right, so currently the price is sitting at 4088, and man, it looks pretty close. Let's go take a look at what the difference is between these two prices. See, it should be 26 points is about the difference between the prices, between the E-mini and, oh, I am looking at the SPX. All right, sorry. I thought I was looking at the ES. I was saying, hey, that looks about the same. All right, the reason why I wanted to go to the E-mini is because I have my volume profile and my structural tools here. Now you see that right here, this purple line is very significant. This is the edge of a volume node. We could move out of this, and if it did, it would probably accelerate towards this 4095, which is about 20 points away. Now, if it did that, can my strategy withstand that, 20 points moving down? I don't know. I'd have to take a look at that. I think it can. Let's take a look at what 20 points down would look like from here. So here's 4091. So 20 points down would be right here. Yeah. So I feel totally comfortable if we start moving down and break through the value node here and move into this low liquidity area. Now, what I'm not so comfortable with is a retracement back up because there's nothing in the way of it moving all the way back up here. So unless this thing breaks through, I'm very trigger happy here. I have my finger on the trigger, ready to push, take profit. because I'm near what I think is going to be the maximum move down here. This is strong support here. It is possible I break through, and if it does, I'm totally good with that. But there's where I make my more nuanced decision that I'm sitting here at support, and I'm getting on in the day, it's 353. I'm also worried about price moving out of here. If it moves out of here, look, I could go from where I'm at now, making $720 to zero just by price moving up 8 points. That's incredible gamma risk. So should I take this profit now? I'm sitting on the edge of support. So the risk is all to the upside. And there's a lot of risk. It looks like I could easily move back up here. But am I going to move down? It looks like moving down is going to be much tougher than moving up. The doggy was just eating one of my reading glasses. Thank you, doggy. Here, chew on this. All right, so now we're moving back down to support. This is strengthening our case. It looks like now I have a double line here. What is all that about? Oh, I see. I was trying to outline a smaller node. But so this is a more local node here. But this is the big node right here between these two. And it looks like we might break through there. If we break through there, that would actually be a good thing, because we only have 5 minutes to go. And it's possible that we might get a pin trade here, which is the ultimate. So right now, this trade is worth $1,030. Now, there was nothing that compelled me to get out of this trade yet. And if I get a little bit further down and I get beyond here, I'm going to feel even better, because I've got all of this area here to work with. I can take it anywhere here, because that'll go across, right across my short strikes on that butterfly. Maximum now, see, it's going up. Some people might look at this and say, that looks like a double bottom there, Ernie. That could just pop right up. And they may be right. Is $1,000 enough? Or should I hold out for the extra $750? I'd take the trade. I would take the trade. As a matter of fact, I'm taking the trade. I'm taking the trade. Now, I might be wrong. Booking $1,000 might have been the wrong thing to do. It could have come down here. But I think, based on my experience and the time that is left, which is only 3 minutes, there's no way for price to improve, or for the value to improve, if I stay right here. It has to go down in order for me to make more money. Will it go down? Maybe. Could it go up? It looks fairly, I really don't know. It's a 50-50 shot. Am I willing to bet that 50-50 shot in the next 2 minutes? My decision is to take it off. No, Charles, it does not depend on my number of losses or average size of losses. It has nothing to do with my previous record. It has everything to do with what's happening right now. That's all that matters. What is happening right now? I do not take profits based on what my previous profits were. That would skew my decision making. I'm focused 100% on this trade alone. And here it is. It's coming home. See, when I took it, now it's going down. Now it's only worth 688. When I took it, I actually took it at about 930, right around there. But that 4-point move decreased the profit by $300. We have 1 minute left. What's going to happen? Wouldn't it be a kicker if it just decided to drop 10 points and then pin the trade? It could do that, but I don't care. I've made 5 times my risk. 500% trade, that's a winner in my book. It could move out of the... Well, all right, so we see exactly where it ended up. Right around here, around 550. Not bad. No, we do not do spreads, David. We're doing spreads because they're butterflies. They're just two spreads. We do the butterfly, as I explained earlier, to get the kind of asymmetry that we're looking for. All right. So hopefully that was worth the wait, educational, showing you exactly how we manage a trade, the framework that we use, and the myriad of decisions that we make at the intersections of the dimensions of that framework. Has to do with the time of the day, has to do with the proximity of price to your strategy, has to do with the volatility, the underlying market structure, the price action, etc. A lot of different things. And there could be other things that could be involved in it as well. Depends on the day. Every day is unique. I had to also use what was my most probable outcome. Take profit now. What is the probability that I could make more or less? What is my risk? How much could it move up? And what would my risk entail there or down? Is there any support or resistance or anything supporting my decision? And this is only one instance. This is only one trade. I'm going to log and journal this trade. I'm going to put it into my journal. I'll make my narrative, and then I'll decide whether or not this trade and the execution of it, my mental facilities and the decision-making that I made prior to the market opening and getting into that trade were all in line. I'll grade each one of those aspects. I'll grade the market, the execution of the strategy, and my mental facilities. How was I psychologically? Was I tired? Was I in good shape? Was I aware? Did I make a sound, rational decision? Was it hurried? Was it not hurried? Etc. And then I'll grade that. And that will be one data point. Well, it'll be 3 data points in one day. But over the course of weeks and months and years, I can look at all those data points and I can spot patterns of behavior and correlate that to my performance. Let's see. Bill says, if you hadn't closed it, though, your long put was in the money and you're short out of the money, so you would have been assigned. No, I would not have been assigned for anything. This is the SPX. There is no assignment risk. It's a cash-settled asset. And even if it was the E-mini and I was assigned one contract, I wouldn't have held it into the close unless I wanted to be assigned that contract. If I wanted to be assigned that contract, then I would just let it be assigned. If I had plenty of money in my account and I could handle the assignment, then I would take that E-mini futures contract and use it for whatever reason I might want to have it assigned. There could be a very good reason, depending on what my larger strategy portfolio was. But in the case of the SPX, that is an index. It is cash settled. It's it's a European style option. There is no assignment. It is settled in cash. So there was no risk. There was no risk either way. If it was the E-mini, I probably would have just gotten out early, as I did anyways. And then there would be no assignment risk there either, because I'd be out of the trade. All right? And this is one of the reasons why we don't trade SPY on 0 DTE, because it's an American style option and there's early assignment risk. With European style, with the SPX, options on the SPX and options on the E-mini, expiration or assignment doesn't happen until after expiration. With the SPY, because it's an American style option, you could get assigned, and there are actually things that you can get assigned to, the underlying SPY ETF. You could get assigned and kicked out of your trade before expiration. And you may not want that. In fact, sometimes, well, it's been my experience, often your broker will kick you out if they think that you're in a margin call potential by getting assigned, and they'll kick you out of the trade. And often that will result in either a meager profit or maybe even a loss. And had they allowed you to stay in, you could have very well have profited. But that's the risk of using American style options, and it's the reason why we don't use the SPY. And it is the reason why we do use options on the SPX or on the NDX. And if we're using the E-mini, then we get out early so that we don't have assignment risk. All right. I'm done. Bill says, yeah, I get those emails regularly. Yep. Our wonderful admin, Pauline, is sending out those emails on a regular basis with all kinds of tips and tricks and techniques and videos and suggestions, etc. every day. Peace to you all. Again, if you'd like to take on a trial, go down below, 4-week trial, and then you can decide whether or not you want to become a professional trader. Music.